Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Talking real money. Back again. You just can't get rid of us. We're like cockroaches. You know, we're going to be here even after everyone else is extinct. Talking real money will live on. We're bigger and better than dinosaurs. No, we actually won't. We'll be gone eventually, and a lot of stockbrokers will be a whole lot happier. Tons
insurance
of
guys that'll be like VE day all over again.
Flooding the streets, turning cars over. That's just a big party when Don and Tom are gone. Thank God. Today, though, apparently somebody likes us because we just get we have been getting so many questions. I can't keep up with them. I do every Friday. I do a pure Q&A podcast. I try to answer 5 or 6 questions. And because, don't want this thing. I hate podcasts that run like 2 hours. I'm not going to listen to a 2-hour podcast. Are you? No.
On World War II, okay. Maybe.
But not on money. So we've got to do an extra one today. This is an extra bonus Q&A podcast. And that's really all it's about is questions and answers from...
Hopefully answers. Okay, so just to clarify, how do people ask us questions?
Well, okay, what happens is the vast majority
how do you do that?
Type them in. It's just the way the world is going. Phone calls are good. We liked hearing your voice. You can call us at 855-935-TALK and leave your question 24/7, or you can go to talkingrealmoney.com and type it in. But you can also speak it into a mic, which we love too.
By the way, that's a great idea because I got like a 2,000-word email today. They wanted all these questions answered. I'm thinking now, just what you just said, I'm going to write them back and say, let's have a phone call.
It's called a
great idea.
Conversation.
It'll be easier anyway. I mean, there's just a lot there.
I keep hitting my mic.
Okay.
It's a big mic. It's a big mic. It's a big mic. This is the coolest mic ever made. It can be any mic. It can be the mic that Sinatra used.
I know.
The actual mic.
Without Sinatra.
With just Don.
Sinatra.
Sorry. That's all you get.
Yeah.
You want to start the first question?
Ooh.
We are just going through these cold, ice cold. We're going to knock them out.
He has not revealed anything.
And we're not like the guys on Car Talk. They used to pre-record and listen to their questions and go, okay, well, let's, no, we're going cold.
Oh, okay. Can I mention a funny aside?
I hope so.
About Car Talk? Yeah. It's funny you raised that. Well, because I mentioned that there's someone that we know that thinks when Don and Tom are the next person comes in and does Talking Real Money. I told that to my wife. She said, oh, well, who are the new Car Talk guys? I thought that's pretty quick, actually. There aren't any.
We're the Money Talk guys.
That's
the way it works.
That's just the way it goes. I think somebody else will do a Money Talk show, but it won't be this one.
You ready for your question? Oh, my gosh, I made him mad. He left. Oh, he's back. Whew. Here you go, Tom. You ready? No? He broke something. Welcome back to the show. I'm Don. Tom's there.
Kinda.
He's dongle challenged.
Yes, dongle challenged.
Challenged.
I'm all dongled up or down or whatever.
I'm going to put one of those. You ever watch SpongeBob with your grandkids or kids?
25 years, but yeah.
Yeah, they always had that little, we are experiencing technical difficulties little sign. I'm going to put that up during the break here. that we just had.
Yeah. Okay.
All right, so let's get into the question before your dongle
Please.
fails completely.
Well, I am getting old, so it does happen. All right, go.
You know, I think it's good. It's good that this is not the radio show, because I think we could get in trouble for kidding around about dongles on the radio.
I think you're probably
But
right.
as a spodcast, as a SpongeBob podcast, and as a podcast, we're good. All right.
Yeah.
Hello, Tom and Don. Tired of me yet? That's what he said. I guess he's written before.
Oh.
I love the podcast, so I enjoy submitting questions. My wife and I are nearing the Roth retirement contribution limits. The goal of my self-employment next year will likely push us over the edge. However, there's always the possibility I don't hit the goal. We both currently max out our Roths at $6,000 each per year on Tom's recommendations from our call last year. If we continue to auto-draft the money into our Roth, but do not actually invest it, i.e. leave it sitting in cash, if we go over the income limit, we can simply pull back at the end of the year with no penalty, correct? I believe the complications penalties kick in on actual investment income derived from those contributions. Hopefully this makes sense.
It makes sense. I mean, the question really at hand is if you make a Roth contribution and then find out later in the year that you made too much money to make that contribution, can you take the money back out? And the answer is, as the caller writer suggests, yes, you can. And he's correct, or she, that the complication comes in if you
Chad.
if you made money, then yes, then it gets very weird about paying tax on that. So that's right, yeah. Honestly, though, if it were my money, I'd just wait till the end of the year, see what happened.
Yeah,
Because what's the point of putting it in? You're not making any money on it anyway.
Well, that's true. But also, if you put it in and you make money on the money, you just have to pay taxes on the money, right?
I believe when you take it back out, you're going to have to pay tax on the gain. Yeah.
Yeah, right. But still,
I
you
see.
had a
So
gain
what you're saying
on-
is go ahead and do it if it doesn't work out. So yeah,
I mean,
I
it
guess you
doesn't
could do
really
that.
make it that
But
complicated.
to put it in just as cash and leave it in cash for a year,
Yeah, that makes no sense.
What's the point of that? Yeah, I agree.
All right, so we got that one done.
Good.
How about double E bonds? You up for double E bonds?
Yeah. Okay.
All right. Hi, guys. What are your thoughts on Series double E bonds for the fixed income portion of a portfolio? I purchased the maximum number of I bonds, but was wondering about double E bonds. The current interest rate is a ridiculously low 0.1%. That's correct. But the bonds, this is an interesting little loophole in savings bonds. If held for the full 20 years, they double, which would mean they double in value. So a $50 face value is worth $100.
$100?
Right. $50 put in is $100.
5% a year then?
It works out to about 3.5.
Yeah, with compounding. Yeah. Okay.
Yeah. So is this a good alternative to BND, the Vanguard Total Bond Index ETF, if you don't need the money for 20 years and are looking for a place to put the fixed income part of your portfolio? Or should I avoid assuming interest rates will rise and I can get a better deal in future CDs or better with bonds or VTIPs or VGIT or VGIS, which are the three funds I currently have fixed income along with I bonds. Thanks so much for your show. I've been listening for about a year and I love it.
You know, I would prefer the bond fund because in that case, you're getting a little more of an interest rate hedge. In other words, they're going to be buying new bonds, and if rates go up on those bonds, you're going to get the higher rates. If you stick with the EEs, you're stuck at the 3.5% where rates could go higher, could go a lot higher. I don't know.
But that's the thing is, there is no knowing. But
No, it's
I have to
speculation.
say, if you are absolutely certain you don't need the money for 20 years, because you can't. It's not like a regular bond where you can take it out prematurely and suffer a loss. You really, you can, but you're not going to make any money. If you know you're going to leave them for 20, a little bit of money in double E's just for the heck of it, I don't see the harm either. Because I don't imagine.
Again, I don't have what's the maximum you can buy. I don't know that. What
that
is the
part I
I-bonds
don't
only
know.
10?
I knew it's 0.1. Let's see. Double E. bonds,
because the I bonds you can only buy 10 per person.
10 grand,
correct?
right?
Yeah.
Purchase limits. See, that's the other thing. Is it's also 10 grand in double E bonds.
Yeah, it's
So to have a little money in double E's and a little money in I's is fine because they just sit at your Treasury Direct account.
yeah.
hang out, and as long.
And then
the problem is, don't forget you have the Treasury Direct
that's
account.
always an issue,
and
right?
make sure it's in your estate plan somewhere.
Correct. Yeah, so people know if something happens to you. Number 2 is then I would still say an intermediate term bond fund for I hope more of your fixed income still makes a great deal of sense.
Absolutely. Think that's wise advice. All right. I don't think we've done this question. I remember reading it kind of, but I don't think we've done it. Let's see if I can. Talking real money. Oh, okay. He's just typing something. Okay. He starts it with the word okay. Okay. I work for a Class A residential building in New York City, and I receive envelopes with gifted money in them. I know this happens because my mother tips everybody in her apartment building in New York. It's what you do. You tip the doorman, you tip the maintenance guys, you tip everybody.
What's the percentage?
I don't know.
Interesting, yeah.
If you have to ask, you can't afford to live in New York.
I can't afford to live in New York. That's foregone conclusion.
I mean, my mom's apartment that she and her husband bought years and years and years ago is worth like millions now. It's just ridiculous. Anyway, once I put it into my account, won't the IRA start asking, hey.
The IRA or the IRS?
He said IRA, but he meant IRS.
Yeah, I was going to say, I don't think the
Irish Republican
Army is that big anymore, but they might be. They might be checking.
Would the IRS
bank
start
balances.
asking me, hey, where did you receive, and he's literally has the word hey, where did you receive this double-digit cash flow? And because he said, I'd like to use this to max out my JP Morgan Chase Roth IRA account I opened this year, which I run myself. I believe this service is free. I don't remember seeing fees. I am also contributing $200 a week to my 401k, which has $17,000 so far because I started contributing this year through my union, which is John Hancock. So any tips and ideas?
Yeah, here's a tip. Use cash to go buy gas and groceries. If you're worried about the potential of somebody later coming back and saying, how did you put $50 in your account? Then don't put $50 in your account. I'm not suggesting you cheat on your taxes. I'm just saying.
And it is, by the way, cheating on your taxes.
Again, please, if you're listening, I'm not suggesting cheating. I'm just saying be smart about it. That's all.
Okay.
I don't know what else to suggest there.
Well, a couple of other things.
Could somebody come back and later and look and audit your bank account and say, where did that $75 come from? Yeah, they could. Sure.
I don't think I'd have a Roth IRA at JP Morgan Chase, because I even though they're not showing you fees, there've got to be some fees there somehow.
Of course there are.
They're either selling commissioned mutual funds or something. I just don't know how they do that
living.
for nothing.
Yeah.
They're doing it. So I'd rather see you at Vanguard or Fidelity or Schwab or TD Ameritrade or somebody like that. I know you can't do much about your 401k, and Tom's right. Just go spend the $1,000.
I don't know what else to say. Yeah.
Good luck. Thanks for the question.
I've never done that myself, by the way, because I never have any. I have $4 in my wallet that I've had for about 6 months. So
yeah, I don't use cash.
I wouldn't know how to anymore. Basically,
it's so great though because, and I don't write checks. It's wonderful. I get the lawn care bill now. I get it through Intuit.
Whatever.
Pay it with Apple Pay.
There you go. Just hold your phone up. Away you go.
That's basically what I do. All right, here we go. Low cost ETF versus Fidelity Zero mutual funds. You know the Fidelity Zero funds.
I do. No calories, no returns, right? Isn't that right? No kidding.
Sugar-free funds. Love your show. I'm debating whether to buy Fidelity Zero Extended Stock Market Fund or Vanguard's Extended Stock Market ETF. Fidelity Zero funds have no fees. Vanguard's ETF has a fee of 0.06%.
6 basis points. Pretty cheap. Yeah.
But am I better off buying Vanguard's anyway? I've heard that ETFs will not incur capital gains until I sell, but mutual funds have capital gains even before I sell them. Is that true? Also, if I am You know, I used to be a talk show host a long time ago. If I am unhappy with Fidelity for some reason, are Fidelity Zero funds not portable to take to another brokerage firm?
Let's see. Taking the last question, I think
They should be portable. They should be portable.
Yeah, I think those are. You could move that to Schwab or some other place. I'm pretty sure that would be okay. In terms of the tax treatment, if it comes down to the 6 basis points or 0, and you really are concerned about taxes because this is money in a brokerage or after tax account, then the exchange traded fund is going to be way more tax efficient. Way more. So if that's really an issue, which I think people sometimes overthink it, but if it is, and I would expect the performance to be different in an exchange traded fund than the Fidelity Zero. I don't know. I don't think we've ever really spent much time looking into how the Fidelity Zero funds are managed or what they hold. Or
I have, and what they are is they're emulators. They don't buy the entire index. They buy what is supposed to play like the index. It's supposed to behave very much like the index. And yet you're right about the difference in returns. The Fidelity Zero Extended Market Fund hasn't existed. It's only for about 4 years. So we can compare a 3-year return between Vanguard and Fidelity. They are ETF.
Mm-hmm. Yep.
And the Fidelity Fund returns about 22, has over the past 3 years returned about 22% a year.
Wow.
Yeah, great return. The Vanguard, though, right at 25% per year.
And so when you say extended market, I'm assuming there's some sort of small cap or some sort of value play or something like that. So that would be the other thing. I don't know that I know
this is a smaller,
what they own. Yeah, I mean, this gets into the nitty gritty.
They fall into the mid cap growth area. Generally, is where they fall on the style charts. The biggest holdings are things like Uber and Airbnb and Lululemon and Blackstone. They're smaller, big companies.
Yeah, these aren't $3 trillion companies like our friends at Apple. Again, if taxes were really an issue,
them that. If you look around my studio, you'll go, "Oh man, did you make Apple a $3 trillion company or what?"
Tim Cook is loving you. If it was for tax reasons, then I would use the exchange traded fund. Yes.
Yeah, I would lean toward the exchange traded too. I just want to look again at and it's interesting, Tom. The Fidelity Zero leans a little smaller and a little more value, just a little.
That's probably because last year small and value had a terrific year. So that might have made the difference for 3 years. So.
Well, no, but Vanguard beat them. Vanguard's actually larger.
I had it backwards. No, I had it backwards.
Yeah, Vanguard's larger and growthier.
Which would have the first 2 years been better, but then this last year, small and value. Anyway, so yeah. Honestly, for that one, 6 dozen, one half or the other. I got time for one more question.
All right.
I got to go. Sorry.
Well, good. This one's from Cass. We
already did one.
We answered
a
question from Cass yesterday.
No, get a different person.
All right, I'll get somebody. Oh, that's from Cass too.
Your financial valet. Come on.
All right, let's see. Okay, here we go. This is a good one. Hey guys, great podcast. Thank you for the entertainment and education. I hear you and other shows talk about taxes and the effects of them on portfolios. However, the numbers thrown out always seem to be just the federal tax rates and do not seem to factor in state taxes for those of us not fortunate enough to live in an income tax-free state. He lives in California. Yeah. Am I missing something? Are states not allowed to charge tax on retirement account distributions? If not, shouldn't you mention state taxes when discussing the effects taxes have on investments and distribution decisions we make? Thanks in advance.
Yeah, no states can tax that. That was one of the reasons my father left California. He hated them taxing his pension. Sure, they can tax you on that, and they doggone will.
We can't.
No, because it's 50 states, I think, right? I mean, how would we do that?
We couldn't, because if you live in New York or California,
you're screwed.
The hit is going to be...
We can just say it. You're screwed.
it's going to be much
tax
higher.
you, and they're going to tax you a lot. So
If
would
you
I
live
retire
in
to one of those
Washington
states?
or Florida, you're not
no
going to get
income
taxed.
tax. Well,
Or Tennessee.
Washington now has the capital gains tax, but that wouldn't be on your retirement accounts.
Right.
So is it something to pay attention to? Sure. Is it something that we can do on the program? No, because how would we do that?
And that's one of the reasons why we say after tax return, just period. You have to consider the taxation, whatever the situation might be. If we give you
California's income tax is like 10% or something.
Right, exactly.
Oh.
I mean, so it's it's in some cases it's close to half what the federal rate is.
Ugh.
I
And
know,
how are
it's a
their
lot of
property
money.
taxes? I don't know.
Everything's
Anyway.
high in California.
Yeah, it's
Including
just
the
an
people.
expensive place to live, but then the sun is
Some
out
of
and
the
you're
people.
not dealing with ice and snow.
Exactly.
So,
Look at
Well, they
where
got that
Tom
going for
lives,
you.
and then do you think maybe those taxes are worth it?
probably I'll pay the sun just to come out for a few minutes, please.
I'll give you 10% of my income for the sun.
Come
Thanks
on. Hey.
so much for being a part of our podcast. Remember to send your questions in at talkingrealmoney.com or by calling 855-935-TALK. Sign up for Retire Meets coming up February 26th. It'll be virtual and maybe in person, we hope. And you can do that at retiremeet.com. We're going to get out of here because I think Tom's got somebody to go meet with. I, on the other hand, have to go to lunch. I'm Don McDonald. That's Tom Cock, hanging out, talking real money.
Talking real money. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.